Okay, so guys, what is it that we need to understand about this entity and its environment in order for us to ultimately meet our objective, which is to give an opinion on whether the financials are free from material misstatements and have therefore been prepared in accordance with the applicable financial reporting framework. We've already discussed in understanding the entity, we therefore need to know what the applicable financial reporting framework is. And we also added other regulations because they affect the financial statements. We said specifically tax, maybe there's industry, maybe there's environmental. All of those affect figures in the financials, so we had already noted we need to be aware of those. But guys, it's not just that. There are other elements that affect those financial statements. There are other elements that help us to determine if there are additional requirements. And so I've put down 6, and these 6 come straight from ISA 315. So the first one, we need to understand the organizational structure. So what do I mean? We need to understand, is this a group or is it just an individual company? Why? Well, if it is a group, then there's going to be additional IFRS requirements. To if it were an individual. What do we mean? Well, IFRS 3 now is applicable, and it wasn't applicable to an individual company. Goodwill calculations are now applicable. There's going to be additional financial statements in the group financial statements. So, understanding the structure affects the financial statements. And so we need to be aware of that. We also need to understand the ownership, the governance, and the business model of this entity. Why? Well, the ownership is going to indicate if there are related parties. And as soon as there are related parties, there's an additional IFRS requirement. You have to now ensure that related parties are at arm's length, the transactions are at arm's length, and that the transactions and any related party is disclosed. So understanding the ownership helps us to identify who related parties are because those affect the financial statements. Understanding the governance. How do they govern this business? Are they very involved in this business? Is there oversight? Are they there to make sure that the business and the financials are prepared correctly? And therefore, in running the business and the financial statements, what is the business model? What is the business's strategies? What are they trying to achieve? And because of the business model, what are the risks in this business? We need to understand that. We need to understand the industry, not just industry regulations, the industry that this business is in. Because if this industry is highly competitive, it's going to put pressure on the business. That's important that we understand that it's highly competitive, there's pressure because of the competition. It's more important for me to be aware of that as an auditor than to ignore that. And we're going to understand why once I've covered all of these factors. We need to understand the measures that they use to assess financial performance, because we need to make sure, is there pressure to achieve targets? Is there pressure for individuals to achieve targets for the financial performance of this business? Why? Because financial performance forms part of the financial statements, guys. So, if there's pressure, what could come about there? We need to understand the financial reporting framework. We've already discussed that. This is the rules to preparing the financial statements, which we as auditors are expressing an opinion on. We need to understand what are the rules that this company has to follow in preparing their financial statements. And then, guys, I've put accounting policies separate from the financial reporting framework, because that framework will indicate when you need to use accounting policies, but they don't tell you how. The accounting policies are therefore the business's own methods at determining how to value or how to calculate a balance within those financials. So it's very important to go and understand those accounting policies, because they affect the financial statements. And so, guys, what you can see here, I have listed 6 considerations we as auditors need to go and understand about this entity, because they all impact on the financials somehow. And it's important that we have considered all of these because of their impact on the financial statements. Why? Why do we need this information? We need this information to help us gather an understanding so that we can identify risks of material misstatements in the financials. This information is going to help us find risks. And I've said, let's give an example for each of those. The first element we said was the organizational structure. 1, we need to understand whether it's a group or an individual, because if it's in a group, there's additional IFRS requirements. So we can put here for 1, the reason why we want to know about whether it's a group is to identify risks of material misstatement because of non-compliance with IFRS 3 if we've got a group. There would then be a risk of material misstatement because they are not complying with the requirements of the financial reporting framework, being part of a group. Let's look at another risk for governance or ownership or business model, which was our second consideration. So for ownership, there's the risk of non-compliance with IFRS once again. In your IAS 24 standard, which deals with your related parties being at arm's length and disclosed. If ownership is not identified, we can't identify related parties and they may not be at arm's length or disclosed as required by the IFRS requirements. Governance. If governance don't have oversight, they don't identify where there could be concerns in the business, there could be misstatements. in terms of the business model, well, the strategy of the business could bring about business risks. So that was 2, ownership, governance, and business models. 3, understanding the industry and the regulations. We said, well, the industry is important to know, is it highly competitive? Why? Because if it's highly competitive, there is pressure not to lose market share. Pressure gives rise to manipulating the financials to appear to not be affected by that pressure. So, for 3, we want to understand the industry because we want to see if there's pressure, which could then result in fraud in the financial statements, or management bias, where there's subjectivity in decisions, in recording transactions. In addition to understanding the industry, we had said all the other regulations, and obviously where there's regulations, there's the risk of non-compliance, which could result in misstatements. That's the risk of non-compliance. So as soon as, guys, you see that there is a regulation, you know there's automatically a risk of non-compliance. Non-compliance due to error, non-compliance due to fraud. Okay, what's the 4th one? Measures to assess financial performance. Is there pressure to achieve targets? If there's pressure, there is a risk of fraud or management bias to show that they are not being affected by that pressure. It's not fraud or management bias. It's a risk of fraud or management bias. So just make sure you note there. Pressure doesn't mean there will be fraud or management bias. Pressure means that there's a risk of fraud or management bias. Just like regulations don't mean there will be non-compliance. It's a risk of non-compliance. Okay, what's the 5th one? The financial reporting framework. That falls in line with this one. Non-compliance with regulations, or IFRS specifically, if we're dealing with the financial reporting framework. It's the risk, not that they are. It's a risk because there is a framework, there are rules, and they might not adhere to it. And 6 we had was accounting policies, own methods, own ways of interpreting data. So there is the risk of management bias or fraud, even to appear to have a great balance when in fact it should be a smaller balance. Okay, where are accounting policies used? They're used in your debtors in determining your allowance for credit losses. They're used in your PPE in determining depreciation, in determining your residual values. They are used in all your assets in determining impairments. So where accounting policies are used, because there isn't a set rule that IFRS gives you, there is a risk of management bias for that balance affected by the accounting policy. So you can see, guys, you now get a scenario about a client. As soon as you see that it is a group, you've got to make a note. Oh, there's a risk here of non-compliance with the group requirements. As soon as you see who the owners are. You've got to make a note. There's a risk, non-compliance, related parties. As soon as you see that there is a business model, you've got to identify the business risks because of those strategies that they've put in place that might not be realistic. And when you see governance are not being involved, you've got a risk immediately because they're not picking up misstatements. As soon as we see that there is an industry that is highly competitive, we're making a note of the pressure because of that highly competitive industry. They want to keep market share. So there could be fraud or management bias to appear like they are keeping market share when they're not. When we see the ways that they measure the financial performance, we automatically identify the pressure there and the risk to achieve that financial performance. Fraud or management bias to achieve it where they are not actually achieving it. When we see the financial reporting framework and the additional regulations, we pick up the risk that they might not be complying with those. And when we start to see the accounting policies that are going to be applicable to this business, we automatically pick up the risk of management bias in calculating those balances and estimates for those accounting policies. So don't just read a scenario anymore, guys. When you're reading the scenario, start picking out these things. Where are these risks? Because I'm reading this information. Because this is the information about the entity and its environment. So, I made a note here. In understanding the entity and the environment, the auditor is required to consider how these inherent risk factors affect the susceptibility of assertions to misstatements. So, every risk we've picked up here from understanding this entity is an inherent risk. And we now need to go and see, is that risk going to affect the assertions in the financials? Is it going to affect the balances, the class of transactions, and the disclosures in the financials? And you can see that some of these are. IFRS 3, we know is going to affect the goodwill. IAS 2, we know is going to affect 24, we know is going to affect the related parties. So we can automatically see the balances and transactions that are applicable or affected by this information. But then we get things like the pressure for financial targets. Well, where could they have manipulated to meet those financial targets? I don't know, anywhere. So now multiple balances and transactions could be affected by that one risk. Okay, not just an individual balance or transaction like your related parties or goodwill, or where there's a specific accounting policy for a balance. So that's why we need to understand the entity and its environment. Guys, let me quickly take you into ISA 315, where you can see where I have highlighted all of these 6 considerations and the fact that they bring about the risks. And at this point, we need to be looking for the risks because we are getting the understanding of this business.